Good day, and welcome back to the Life License Qualification Program video series as presented by Business Career College Corporation. My name is Jason Watt, and what we're going to talk about in this particular video is the taxation of investment income. Now, you have to know the broad details of taxation and investment income. You have to know which sources of income are more favorable or less favorable than others, but you don't necessarily have to know all the details that we're going to go through over the next few minutes. I do think it's useful to know them later on, but don't memorize a bunch of these facts and figures. I will show you exactly what you have to memorize here when I get to it. Now, in the last videos, we looked at a taxpayer who was earning $70,000 of income, and you might recall that we had $10,000 in deductions. Either way, that person was at a 22% marginal tax rate. So $70,000 of income at a 22% tax rate. Now let's say that this particular income earner earned three sources of investment income. We could have regular income, we could have dividend income, and we could have a capital gain. Now, there's actually no category of income called regular income, but this would include, this type of income would include almost everything that we make. This would include things like salary. This would include, though notably for investment purposes, interest income, that is from a savings account or a GIC. This would include rental income. This would include proceeds from a life insurance policy when taxable, which is relatively rare, as you'll see in Module 8. Life insurance, okay? But you could have some situations where you end up with a portion of a life insurance policy tax, notably when you take money out of a policy during lifetime. So regular income, let's say this person earns $100 in interest for the year. They're going to receive a T3. The T3 will describe for them how much interest, sorry, a T5, I apologize. I'm going to get a T5. And the T5 will describe for them how much income they're going to receive. So how much income they've received, $100 in this case. It'll be taxed at 22%. This person would have $22 in federal tax to pay, plus, of course, whatever provincial tax there happens to be. But by keeping this to federal tax, we keep the discussion fairly simple. So this person has $22 in tax to pay. They would get to keep, out of their original $100, 78 of it after taxes or net of taxation. Dividend income. Dividend income gets a little more complicated. The dividends we're referring to here are the dividends that come about as a result of owning stock or shares, which are the same thing. Stock and shares, really the same thing. That's ownership of a company. There are actually two kinds of dividend income that you can earn. You can earn dividend income from a non-publicly traded company at what we call a Canadian Controlled Private Corporation, a CCPC. Those dividends are taxed a little bit differently, but using the same set of principles that we see here. Well, this dividend that I'm going to show you comes about if you own shares in a publicly traded Canadian company, a company like Sun Life Financial, or Royal Bank of Canada, or Manulife Financial, or Magna Corporation, whatever you happen to have. So that dividend income then, let's say again this person earns $100 in dividend income. So now they're at $70,100. The first thing that happens, and this is a little bit confusing, oh, and I should be clear here too, that these dividends are not the same As the dividends, you'll learn about Module 8, and you'll learn about participating whole life insurance. If you happen to end up paying tax because you received a dividend from a participating whole life policy, that is proceeds from taxable life insurance, that will be taxed as regular income. That's a different kind of dividend than these stock or share dividends. So, this dividend would be grossed up by 45%. You can actually type this into your calculator just like this if you happen to be using a simple calculator in this form. This is, by the way, the type of calculator that I would recommend you have available for this course. So you take $100 and you would just type 100 plus 45%, and the answer is right there on the face of your calculator, 145. If you have an accounting calculator or a scientific calculator, that won't work so neatly, but that's okay. As long as you can get to 145. If you have to, you might do 100 times 1.45. So now we have 145. Well, that's how much income this person is seen to have earned because of this dividend. And now we would apply this person's marginal tax rate, that 22% marginal tax rate. 22% of 145 is $31.90, which would be a lot of tax to pay on $100 of income. That's worse than your tax you have to pay on a savings account. So Revenue Canada says, well, hang on a second. We've taxed your dividend income, but we had already taxed the corporation before they were allowed to pay you that dividend. So really, you've been subject here to double taxation. You might recall in the previous set of videos we said that we avoid double taxation in this country. So to get back from this double taxation, what happens is we apply what's called the Dividend Tax Credits. A tax credit, you'll recall from the previous series of videos, reduces the tax payable. So we take the $145, the grossed up amount. Now we would apply the tax credit of 19%. It's still 19% as of 2009. For dividends earned in 2010, this rate will be reduced to 18% and this rate will be reduced to 44%. You don't have to memorize that. So now we take our $145 times 19% and we get $27.55. So this tax credit then will reduce our tax payable accordingly. And now we end up with a $4.35 tax bill on $100 of income. That $145, that's just a notional figure. It only exists on your tax return and nowhere else. There's nowhere else you have to worry about that. That money never actually existed. This person got a check for $100 and ended up paying tax of $4.35. They were allowed to keep then out of their original $100, almost all of it, $95.65. Much more favorable than interest income. Generally speaking, the lower the tax bill somebody would have, or the lower the tax bracket somebody's in, the more favorable dividends are for them. Somebody in the highest tax bracket ends up paying tax at quite a bit higher rate on their dividends, but somebody in a relatively low tax bracket, like 22%, hardly pays any tax at all on their dividends.